Hello, everybody. This is Paul Nathanson with the Policy Resolution Group at Bracewell. Welcome to the One Voice Washington, D.C. update, where we talk about federal government policy developments, both in the administration and on Capitol Hill, and we delve into some trade issues as well. With me, as always, is my partners in crime from the Franklin Partnership, Omar Nashashibi and John Guzik. Caitlin Sickles is absent this week. And we first want to say a thanks to our sponsors of this podcast, Federated Insurance. So they are sponsoring this podcast, this webinar, and we appreciate their support. So, hey, John, why don't you go over what's the plans today?
Thanks, Paul. Well, we're going to start off talking about the latest what's going on in Congress. We'll have a little discussion about regulations that are moving forward, and there's a number of them moving forward. And then we'll end up with taxes, trade, and supply chain issues that is being considered in Washington at the administration level. So let's start with Congress. Congress is out of session for the entire month of August. They left at the end of July. The Senate comes back on September 5th. The House comes back on September 12th. Both chambers have a lot of work is building up on their agenda. Before the Congress broke, the House only passed one of 12 appropriations bills. Typically, you see a handful of bills pass before they break for the August recess. Surprisingly, the Senate, before they broke for August, the Senate Appropriations Committee passed all 12 bills out of the Appropriations Committee in a bipartisan way. And so it really does look like we are heading to a government shutdown. That's when government funding runs out on September 30th. They still could pass a continuing resolution, but essentially House Republicans cannot agree on spending levels. The Senate Republicans the Senate is using the agreement in the debt ceiling using FY23 numbers. Many of the conservatives in the House want to use FY22 numbers, which is more dramatic cuts. And so that is a stalemate going on between moderate Republicans in the House and very conservative Republicans in the House. As we have mentioned in past webinars and on our Monday morning calls, September 30th is a very critical date in Congress. There's a number of expiring provisions, essentially must pass provisions, like the FAA reauthorization. The House passed it in a somewhat controversial manner. The Senate is yet to consider it. There's the 5-year reauthorization of the Farm Bill. That is pending out there. In the past, the Farm Bill has been largely agriculture programs, but as the country and everything has evolved, it has become more of a program for housing and food programs, which were part of the debt ceiling debate. So that is going to be controversial. It's not going to be an easy pass like it has been in the past. There's a Pandemic Hazard Preparedness Act that needs to be reauthorized. The temporary assistance for needy families, that expires. That is several welfare programs that may be wrapped into the Farm Bill, but it's yet to be determined. We've got National Flood Insurance expires, and of course the all-important National Defense Authorization Bill. The House passed it on a very largely on a partisan vote, and again, surprisingly, the Senate passed a very bipartisan National Defense Authorization with a total of, I think, 86 votes that passed the Senate. Omar?
Yeah, and that's to your point there on Defense Authorization Act. We're going to be looking at that as one of the few vehicles that are out there to actually does get moved. I think they will get through some of the cultural issues, and that is the major defense policy bill that's passed every year since 1961. So we do expect that to get out there. And I think the flood insurance that you mentioned is also important because there's a lot of homeowners out there that are that's going to really have some impact on the economy. That's out. One other area on the Defense Authorization Act, it does have language in the House bill that codifies language that Biden has been moving on through executive orders to do additional requirements for U.S. manufactured content and under Buy America. So the current thresholds have increased up to 60 and then 65%, and then it's going to go up to 75% in 2029 for major defense acquisition programs. So that ramp up target is now going to be codified in law if this language ends up holding. That's in there as well. But one thing that we want to spend a little bit of time on, knowing how important it is to this group, is the research and development tax issue with regards to capitalization, amortization, and the limitation on the ability to fully expense it going back to 2022. As you know, we've been lobbying on this extensively. We got it included in a House committee passed bill that Republicans had worked on that gives you a retroactive fix on the R&D issue to January of 2022, returns bonus to 100% from 80%, and also takes care of the full EBITDA standard under 163J. The issues that you're facing right now are ones that we heard about. We were in the meeting in the Capitol where Republicans were planning course. SALT, state and local tax deduction, came up. There are a handful of California, New York, New Jersey members in the Republican side that want to see a SALT deduction fix, but there's at least 20 conservative Republicans that are saying no to that, which leaves them at somewhat of a stalemate, which is part of the reason why you saw them not get a full vote in the House prior to leaving for the August recess John referenced. There are some that are still hopeful we might get a vote on this House bill at some point in the October maybe timeframe. I'm personally increasingly skeptical. I don't think that we need to get this bill passed on the House floor, as opposed to just getting the 3 provisions that we are really focused on, which can be added into at the end of the year. So as you read in the newspapers quite a bit that the tax bill has stalled, that's correct. It does have challenges. It has stalled, but that does not mean we do not have a good chance of getting our language included in the year-end bill and whatever else that they negotiate, because there's a number of other things that they're negotiating for the year-end side, regardless of taxes. And so we'll have further updates on where we are on that. But we do want to touch on workforce as well. As we mentioned, there were some challenges on the tax side over for House Republicans. Senate Democrats, right before leaving for the August break, were hoping to move a number of workforce bills that we're working on. One Voice has endorsed several of the bills you see before you: National Apprenticeship Act, Youth Apprenticeship Advancement Act. The Jobs Act of 2023 is something on which we've been lobbying consider for a long time. That's very bipartisan, would work to lower the requirements for Pell Grants for more short-term applications. The issue that we heard there is the markup. That's what it's called. It's a markup is when you advance legislation. It has now been postponed indefinitely. They decided to delay it the night before, is what committee staff told us yesterday. And the reason being, they weren't explicit, but it seems like they couldn't fully put a package together that they could ultimately get over to the Senate floor. So now they're looking at potentially trying to wrap some of these bills into something broader at the end of the year, similar to what we're also trying to do on taxes. So that's one of the concerns that we've got, is that we're still getting tied up on some of these important, typically nonpartisan issues. And that's where that stands as of what staff told us why they had to cancel and delay that markup there. But John, on the regulatory side, we finally are starting to see quite a bit of movement, especially on injury illness reporting requirement.
Yeah. Before we get to injury and illness, the next few slides, you're going to see the term OIRA, Office of Regulatory Review. That is the final step before a regulation gets reviewed by Office of Management and Budget in the White House. And so it's the last step before final publication of a rule or such. And so when you see that term OIRA, it means that the rules a rule is being finalized. And to Omar, your point, injury illness reporting requirement was finalized. It takes effect in 2024 for NAICS code 31-33. Basically, essentially, those who have more than 100 employees must file electronically annually your Form 300, which is the log of your injury and illness reports. You need to file 301, your injury illness incident reports, in addition to your 300A, which is a summary of your injury and illness reports. Those who have between 20 and 249 employees must continue to file the 300A, which is the summary of your injury and illnesses. Keep in mind, and we have warned manufacturers and the administration and our coalition partners that the concern of filing electronically is that then the administration will be able to publish these injury and illnesses, and it may reflect poorly on certain industries. And you may have to, if they publish a summary of something, of an incident that may not be life-threatening, but it'll be reported publicly, and that's what OSHA has indicated that they're going to do, is publish some of these injury and illness reports.
One distinction to keep in mind is that for those of you that have multiple facilities, note that they use the word establishments on this slide and on the previous one. So what it means is that it's per form that you fill out. So you're filing a 300A per facility. If you have a facility, say, in Michigan and Tennessee or Ohio and Indiana, your head count for whether or not you exceed 100 or more employees is going to be per facility. So that's how they determine this, and that's something to keep in mind from there as well when you're doing that calculation that will start taking effect next year for your March 2024 filings to reflect the previous year. But John, you won't just jump back in here. There's quite a bit going on the OSHA heat rule. As you all know, we're still awaiting the convening by OSHA of the Small Business Administration SBREFA review panel. We've been in touch with SBA on Wednesday of this week about their plans on who they're submitting for recommendations and what they're talking about for the next steps. But in the interim, John, this is here what the April 8th of 2022, there was a national emphasis program initiative issued by the Department of Labor, OSHA, on heat advisory, and it looks like they're really starting to ramp up the emphasis of that program.
Yeah, we've all seen and heard in the news the heat that's crossing this country. And on July 27th of this year, OSHA sent out a little reminder of the warning for heat hazard, reminding employers that their obligation is to keep their employees safe from heat injury. And they did point out, as part of their national emphasis program that Omar pointed out, is they did point out in that July 27th announcement that they are going to increase enforcement of heat injury and illness, injury and illnesses moving forward. The next slide is a nice little chart that shows what the rights are to your employees. Employees' right to know, and they are allowed to confidentially file a complaint that you as an employer are not providing. You're not providing necessary relief during heat injury and illnesses, and that OSHA reminds employers that there can be no retaliation, for those who do file those reports.
That's right. So continue to watch closely in this space. Obviously, there's been quite a bit of attention. You've seen some members of Congress starting to increase their activity. The White House is certainly increasing their awareness campaign in partnership with unions that are out there, and especially look at the Southwest and what happened in Phoenix over the last month and a half. So this is an area to watch, particularly if you're having an OSHA visit coming over, and that's an area of where they're going to have an increased emphasis and increased focus that's there. Similar on warehouse and distribution emphasis and looking at preventing workplace hazards there. A number of different areas that are really combining spaces in which we've been watching closely and looking at, from powered industrial vehicle operations to also walking working surfaces. And those are some other areas that they're looking at general industry regulations. So we flagged that and looking at that a bit more broadly. One item we've mentioned in the past on the OIRA is reviewing, Office of Information Regulatory Affairs is reviewing the worker walk-around standard that the Obama administration initially tried to put together. That's where even if you're a non-union shop, an employee may ask for a representative from a union to be on the tour with on the inspection with OSHA as the representative of the employees, even if you are, again, a non-organized shop that is slated to go through it. To John's point, the way you're going to read these charts is when it says NPRM, that means a notice of proposed rulemaking. That is the step we take before they issue a final rule, meaning they'll allow the public to comment. When you look at the dates, 6/00/23, that means in the month of June, they were slated to issue it. They're late, they sent it to OIRA, and that's how you expect it to come out soon. You've also got a few other delays on EEO1 filings, delayed from mid-July. If you hadn't already submitted your EEO1 for your collection, they have now announced that they're going to have that due sometime in September. John, a big one that we're watching closely, it should be out sometime in August, is the one overtime. That's over at OIRA.
Yeah, this is, from the results of our One Voice survey that we ask at the end of every year, beginning of every year, we asked what impact the overtime rule would have on the One Voice establishments. And it has indicated traditionally that, 1 to 3, 1 to 5 employees could be impacted by an increase in the overtime rule. We are expecting a significant increase in the overtime rule, perhaps $50,000 may end up being that threshold. Is that right about right, Omar, what you hear?
Yeah, there could be a base of 50,000. Some on the Hill are calling for 58, 55,000. Progressives are calling for 86,000. But I think, John, you're right, probably over 50.
Yeah. So, and then also, OIRA is looking at, there's a cost benefit analysis rollout that's out there. And for the first time, they're looking at considering as when an agency considers a cost benefit analysis of a particular rule or proposal, they must consider the ecosystem, must consider the cost of the environment moving forward.
And so that one's important because they already do this in some areas, but they're trying to make this a whole of government approach. So what they're saying is if you're going to go develop a strip of land, for example, and you remove all of the trees, even though the land is not being used for any other economic purposes, you've now eliminated shade, you've eliminated something that captures ozone. If you are eliminating a wetland, even though it's not currently developed, then are you going to increase the nearby suburb or community to make them more prone for flooding? So while on one hand, they're trying to advance that for the first time, as John mentioned, across and formalize it, then you also have the Council of Economic Quality, a part of the White House, releasing their proposal on the National Environmental Protection Act and how they can move forward and expedite some of their process and reviews. Republicans on Capitol Hill for these permitting processes obviously are not as thrilled with this NEPA proposal that would have additional criteria as part of that review that's out there, but that is still something that they're going to move forward with. Sierra Club put out a statement in support of that one. Quickly, just the next few slides here for those of you that have taken the employee retention tax credit. Many of you have in the past taken that along with the Paycheck Protection Program as part of the COVID pandemic relief programs that were put together from the previous administration. Want to put on your radar screen just a few things. That the IRS is now saying that their ERC backlog has been eliminated, that 99% of claims are approximately 3 months old, and so that they've gotten down to that backlog of review on that of secondary audits. You all remember starting last summer, there were major delays that were out there. We filed comments as one voice last Thursday with the House Ways and Means Committee, still raising concerns because of a number of our members as late as this spring were still telling us that they were facing delays. But that's the latest that they're claiming at least that they're moving forward. If those of you are still beyond that, say 90 days into 6 months, 9 months delays on your ERTC refunds, please let us know and we can certainly confidentially try to help you. But John, I mean, go back to some of the hearings they've had on the Hill. Fraud is still a big issue. Scams are a big concern over at the IRS too.
At least we're hearing in DC on the news media a lot of ads for companies that are offering to provide assistance to people who have taken advantage of the employee retention credit. And so this is just a warning. This is, hey, just beware of these scams. Omar, I really think that they've really beefed up the resolution and processing of the employee retention credits is because the threat of the Ways and Means oversight hearing, which you said, we commented on, the threat of bringing in the administration to be challenged on the delays in processing these claims, it forced them to move forward rather quickly.
Yeah, I agree. They were getting a lot of pressure on both the scam side and also on just the processing. So appreciate those of you that did help weigh in and took our surveys. Shows that some of that does help move the needle. I do want to also last one on ERTC here, flag the frequently asked questions FAQ guidance that was just issued by the IRS last week and on July 28th. What is important here, there's a number of updates. We really want to flag this one, that what if my business was partially suspended if I had a supply chain issue, and that's when they applied. And they're saying that it applied only when the employer absolutely could not operate without the supplier's product and the supplier was fully or partially suspended themselves, and you couldn't obtain the supplier's goods or materials elsewhere regardless of cost. So those of you that are still waiting and maybe have not had it fully processed and you were looking at supply chain as one of the reasons why you claimed the employee retention credit, please factor that one as well. And so there's a number of FAQs. There's the link down below for your CPA or in-house CFO to take a look at a later time. One other area, speaking of compliance and auditing, OIRA is also reviewing the DoD's CMMC, notice of proposed rulemaking. What CMMC, that's basically the cyber program. It's called the Cyber Maturity Model Certification Framework that DoD really started to implement in 2017, following what we were told, what started with the Obama administration, and then December 17, Trump had to implement it. This is similar to the NIST-800 implementation of the requirements that you all have to have. In CMMC 2.0, DoD simplified the structures a little bit and took it from, I think it was maybe 5 levels. Now we're down to levels 1, 2, and 3. Based on level 1, you have somewhere around 15-step requirements. Level 2, it starts increasing. Any of you doing any subcontract work or prime work with the Department of Defense, this is very important for you all to take a look at. When this comes out in September, we will certainly make you all aware of what compliance and requirements. A little editorializing before I turn it to John on the apprenticeship rule. I personally believe that you should not just look at this if you are a DoD contractor, if you are anyone supplying government, and if you are supplying a publicly traded company in your customer chain, we would suggest you look at CMMC and try to comply with at least level 1.0, as level 1 will probably be a request if it's not already from some of your customers. John, a couple of good positive things, at least on the apprenticeship side.
Yes, as you look at the bottom of this slide, it's expected in August of this year, a notice of public rulemaking, basically doing an update, a modernization of Apprenticeship Act rules and requirements. And so we do expect that to come out relatively soon in the month ahead. And then the other good news is the Administration Department of Labor has announced $6.5 million in additional apprenticeship grants will be released by the Department of Labor.
All right. One other item before we get into trade and supply chains and get ready to round it out. The Biden administration did just issue an executive order. July 28th was a busy day. Typically, that's considered most of Washington. If you send emails to many people right now, John and I do, you get out of office replies. The executive order from the White House on that Friday before the August break looks at how the U.S. can focus more of the R&D process on internal and Buy America domestic production. Typically, what the U.S. does, and if you look at this, I wrote an article on it once, but it's incredible how much the U.S. has actually invested through DARPA and ARPA and EARPA and different entities in terms of research that was ultimately commercialized and then taken out into procurement. So what they're trying to find is ways that they can rely on domestic production for critical industries while maintaining that flexibility for R&D partnerships, public-private partnerships, not just over at DoD, but also at DOE, things like that. You know, those yellow trash cans that are on highways to protect you from crashing, those are actually designed as part of a government R&D effort that was funded for private sector. So different things like that that are out there. Speaking of which, Department of Energy on Monday announced that it was adding copper to the critical minerals list. We like to break this down in multiple facets for you. If you didn't put the link here, but this is in their report that they issued the other day. They also had on the short term, so the short term was going up to about 2025, and they did not have copper as high on the concern. It was considered on the lower importance to energy side. It was down next to manganese and titanium. On the medium term, this is the chart you see in front of you going forward the 25 to 35 decade. They did elevate that along with electrical steel into the levels of critical minerals, and that designation by the Department of Energy does a number of things. Could also potentially lead to additional Defense Production Act funding, but it also means that those projects here in the U.S. would be eligible for the Inflation Reduction Act 48C tax incentives for production, and that could really help spur some additional domestic activity here in the U.S. So that's something to watch closely, and that did just happen on Monday on copper, and we know a number of our members use that and wanted to flag that as well. John, something that should have been made public a while ago, but seemingly was just released shortly here. USTR is talking about maybe completing the 301 review in the fall.
Yes, as we've mentioned in past webinars and on the Monday calls, the USTR is in the process of a 4-year review of the Section 301 tariffs against China. And they have an application process, they had public filings, 1,500 people have submitted comments regarding the tariffs. And so we knew it was going to take a while. And when Ambassador Tai testified before the Senate committee, she was specifically asked the question as, okay, when is this 4-year review going to conclude? And she did in a follow-up in writing said that she anticipates the 4-year review to conclude this fall, perhaps as early as September.
Paul, quite a bit on the sticking with international a bit here, steel and aluminum.
Yeah, as we've been reporting, we've been closely watching the U.S.-EU negotiations on steel tariffs. As you may recall, about over a year ago, the US and the EU reached an agreement where they ended the Section 232 steel and aluminum tariffs on EU steel products and replaced them with a tariff rate quota. That deal actually was only for 1 year, and the plans were always to negotiate another agreement where the U.S. wanted to create what is being called a green steel club, where they would base tariffs on carbon emissions. So you'd basically have two tiers of tariffs: a lower tariff for carbon emission-friendly countries, and a higher tariff for those who produce steel in a less environmentally friendly way, where you could translate that into one word: China. But the negotiations are going slow. The EU is very hesitant to enter into an agreement that they don't see as WTO compliant. There has been some the negotiations are picking up, because if they don't reach a deal by the deadline, then theoretically the US could reimpose Section 232 tariffs that would be 25% on steel and from the EU and 10% on aluminum. Also, the EU doesn't have a big incentive because they already have their own carbon-based regime that they're going to roll out soon. The initials are CBAM. The talks continue. The other obstacle that they have is that the EU, which has retaliatory tariffs, by the way, that if the US reinstates the Section 232 tariffs, they have a process where they can't simply just not retaliate, or these tariffs would double actually. So it's very complicated. And I think Omar and John agree, we still think there will be some kind of deal that at a minimum will extend the current tariff rate quotas. Nobody wants to get into a trade war, but we are skeptical that the Green Steel Club deal is going to be reached by the end of October. They're going to have to do some kind of extension of the current deal, even though there are some complications.
But to get that extension done, the EU's gonna have to jump through some hoops, because you're gonna have to have the entire EU buy-in for a delay in extension.
Yeah, it is complicated. It's interesting that they have intensified those discussions. Also wanted to report that the GAO issued a report recently on the Section 232 exclusion process, where, as you can see, they concluded that importers are not using Section 232 exclusions. I think this report, rather than it's from the user point of view, was more towards the steel producer point of view regarding the criticisms of the Commerce Department exclusion process, including that some products were granted exclusions that shouldn't have gotten exclusions. I think the report really, the focus of this report should have been on how bad the exclusion process runs in general, which I think anybody on this call who has gotten exclusions or have tried to get exclusions know that a lot of work needs to be done on that. And in fact, there is some legislation, Section 232 reform legislation, that has been talked about and is on the Hill. And always the exclusion process is a part of the discussions, because it just is not an efficient process, as you all know.
And to add to this, one thing maybe just to call out, and then a question of some of you all, if you could give us some feedback at some point. What we took away from this report, in addition, Paul, I think you're exactly right on it, but I also look at why aren't people taking advantage of the exclusions that have been granted? So what basically this chart is telling you is that the Department of Commerce granted your exclusion, meaning they said, okay, you can bring in this product without a tariff of 25 on steel or 10% on aluminum. Yet the people that requested this tariff lifting didn't use it. That's literally telling you only 1 in 10 claimed it. And some of these have tariffs that are called GAES, generally accepted exclusions that have been submitted. And that's where the Commerce Department did for everybody. Even if you did not submit an exclusion yourself, you would have been eligible to not have to pay the tariffs. So there's either a disconnect between whether they're not approving metals any of our members use, or just our members aren't aware that there's an exclusion granted and only 1 in 10 are actually taking effect. So that's something that we'd like, if you all can maybe weigh in with us at some point that might be involved in that, that'd be helpful to learn on that. Just about 3-4 slides here before we wrap up. As always, please type in any questions you've got over in the right-hand box and we'll answer it here. In just a few minutes ago, a couple of other things. Here, Mexico, every once in a while we like to throw in a slide on what's going on there. Mexico has now become the top trading partner in the with the United States, and taking a look at the overall trade with regards to tariffs imposed on China. And you can see how those numbers have continued to go up with regards to Mexico and down with regards to China. You can read that in a number of different ways. Sticking with the some of the conflict minerals and China issues and foreign sourcing, we thought we would put this report out there for you, going back to the Government Accountability Office. This is where they talk about the amount of conflict mineral reports. You remember under Dodd-Frank, you're still required to determine whether or not the source of your tin, tungsten, tantalum, or gold 3TG is coming from the Democratic Republic of Congo or surrounding countries. And most of them are still coming back and saying they still could not determine, or many of them rather, 49% could not determine the source of the conflict minerals. So again, well-intentioned law and the regulation that ultimately does not seem to be going about the way that people had hoped there. Last 2 slides here, just change it in the manufacturing jobs and looking at some of the locations. We thought some of the increases, as you can see in the US overall, is 6.4% rather, from January of 2021 going into May of 2023, according to the Bureau of Labor Statistics. And you can see where some of the increases are across the country as well. And then lastly, turn it over to Paul here, just some of the energy sources for the first half of the year. Obviously, this chart is a little oversimplified since it varies greatly by region, but in terms of being able to look at some trend lines where some things might fall, we thought this was indicative and something to take a look at as people are starting to look at the future. But Paul, a few other things coming out.
Sure. As you might have seen, the job report was released by the Labor Department today that showed the U.S. added 187,000 jobs in July. I'm just putting this up there as well as a recent story on the R&D expensing issue to ask again NTMA and PMA members, if you're interested in talking to the media about these issues, workforce or tax issues, just reach out to me. The jobs report always generates an Associated Press story that they like to put people into the story so that it's not just about statistics. So they always talk to a manufacturer or two about what they're seeing on the jobs front. It's a nice opportunity to get your company name in the paper in a positive way, and they contact me about every 2 months, 3 months. So just reach out to me, and we will talk to you more about how to go about that. Same with R&D tax expensing. R&D expensing, it really helps Omar and John on the Hill to get some attention on that in the media about how important it is to manufacturers. So reach out to me. We will be recording another new One Voice podcast next week, but all the topics that we discussed today, we discuss on this podcast, on that podcast, where you can download it wherever you gather your favorite podcasts.
As always, appreciate any support you can continue to give to both NTMA and PMA for the advocacy fund that we've been continuing to be able to put this program together over the last couple years now, and we'll continue to bring them as long as you all still want them. As we bring to an end, last chance for any questions. You all feel free to type them in the box over on the right. I know we covered quite a bit, ranging from taxes to regulations to tariffs and trade. So happily to go in a little bit further as we just get to about 12:34 Eastern right now. Okay. Not seeing any come through. Thank you all. Enjoy your weekend. We will talk to you next month.
Thank you.